when AI and Bitcoin are correlated, it's going to be doubly bad for the stock. The AI trade has taken a lot of the wind out of the sails of crypto. Just look at the Bitcoin miners who are aggressively pivoting to AI. So they're basically like selling Bitcoin to fund this pivot. And if Bitcoin sells off, they literally need to raise more debt at the same time.
What is your view on the 4-year cycle? This is a big debate right now currently. Is a 4-year cycle still relevant?
I tend to give it.
Very pleased to be welcoming back to the show Matthew Sigel. He's the head of digital assets research at VanEck and the portfolio manager of the Onchain economy ETF. We'll be talking about what it means to be living in an on-chain economy. But first, let's talk about Bitcoin. Very good to see you again, Matthew. Welcome back.
Hey, David. Yeah, good to be with you.
Last time you were on the show was April. I had you on a couple of times on the show. Check out our last conversation. I spoke with you live at a conference in New York back then in April. Bitcoin was... the interesting thing about Bitcoin is that it underperformed the stock market when the stock market was up all year. And now we're speaking on the 20th of November. It's at 86,000 is the latest price on my screen. And it's basically down about 11% year to date when the NASDAQ is up a lot more than that. So it's been a disappointing year for a lot of people who have been betting on Bitcoin. It's probably disappointing for yourself. You've been calling for Bitcoin to go higher. Right, I think on the show you said there's a possibility it could rebound to 180K by Q4. Let's walk through the assumptions of that call and basically why Bitcoin was so disappointing this year. The fundamental reasons for why Bitcoin underperformed. Let's start with that.
Yeah, I think that the AI trade has frankly taken a lot of the wind out of the sails of crypto. And you can even just look at the Bitcoin miners who are aggressively pivoting to AI. And for me, that's one of the principal reasons why crypto has underperformed this year is that there have been better things to buy. So now we're in a situation where BTC and NVIDIA are pretty highly correlated. And I think that Bitcoin is acting as a little bit of leverage on top of that AI trade. So many of these Bitcoin miners are aggressively repurposing their mining facilities to serve the AI market. That requires a lot of CapEx in order to upgrade these data centers and possibly fill them with GPUs. And they're using the cash generated from Bitcoin mining to fund part of that CapEx. A lot of it is debt funded. So what you have is when Bitcoin is selling off because of debt fears, which, or rather when the AI trade sells off because of debt fears, that is a double whammy to these stocks because it means that their CapEx requirements go up because the cash that they're generating from selling Bitcoin is going down. So I think that's how BTC and NVIDIA are essentially connected and correlated. The more GPU demand there is, the fewer BTC the miners have to sell in order to fund these pivots, right? Because a lot of them are literally borrowing GPUs, borrowing money to buy GPUs, and the interest rate on those loans is going to be dependent on the supply-demand dynamic for GPUs.
I have here a tweet that you made that basically highlights this. So why are NVIDIA and BTC correlated? I correct me if I'm wrong, Matthew, but I thought GPU mining was still was no longer, it's basically obsolete. People have moved on from using GPUs for Bitcoin mining, or are they still using that in some certain areas, large scale?
No, you're right. The GPU mining is called AI LLM compute power, right? Yeah. So it's more that these data centers are full of Bitcoin mining ASICs. The Bitcoin miners have basically lose money over the cycle because their revenues go down by 50% every year. So they've realized that there's a better return on that electricity if they rip out the mining machines, upgrade these facilities with redundant power, better fiber connections, and put in GPUs instead of Bitcoin mining ASICs. It's a pretty expensive upgrade cycle, but the returns over the cycle are better. So they're basically like selling Bitcoin to fund this pivot. And when credit conditions tighten, then the cost of the debt that they need to repurpose this facility goes up. And if Bitcoin sells off because credit conditions are tightening, then they literally need to raise more debt at the same time. So these are really levered bets on AI. And then when AI and Bitcoin are correlated, it's going to be doubly bad for the stock. So that's what we've seen here in the last month.
So you're saying a big portion of the selling was done by miners, if I'm not mistaken.
Throughout October, yes, Bitcoin miners were aggressively selling. We've of course noticed the narrative out there that kind of there's OG Bitcoin whales that have been selling their coins. Our read of the data does not show that to be the case. So we see that the oldest holders of Bitcoin have actually increased their holdings. So there have been in that 3 to 5 year cohort, those who have owned Bitcoin for between 3 to 5 years, their holdings have decreased in the last 6 months or so. Some of that is coins that are just aging into older cohorts, into the 5-year plus cohort. But at least our read of the data doesn't support this like Bitcoin OG whale selling, which leads me to believe that maybe the miners are playing a bigger role on the margin than the market realizes. And I think that has to do with their CapEx requirements to fund these AI pivots.
This happened in the summertime, so it's not recent news, but I'll just address it anyway. Galaxy Digital made one of the biggest exits of Bitcoin in recent times. For them, at least, Galaxy completed the sale of more than 80,000 Bitcoin valued at over $9 billion based on current market prices for a Satoshi-era investor, representing one of the earliest and most significant exits from the digital asset market. The transaction was part of the investor's broader estate planning strategy. Do you have any insight as to why Galaxy and some others like them have exited the Bitcoin market earlier this year?
I mean, that was Galaxy executing a trade on behalf of a large client. It was definitely a notable transaction. But if you look at the aggregate data for whales that have held their coins for more than 5 years, that data does not show that those whales are dumping. In fact, those aged coins continue to increase. The selling is coming from mid-cycle holders, coins that have last moved, say, 3 to 5 years ago. So those folks might be playing the 4-year cycle. Like I think there's definitely some who are giving more benefit of the doubt to the 4-year cycle. But yeah, that's our read of the data. I would also note, Galaxy had to raise capital after that quarter. So, they breathlessly reported that they had the best quarter in their history, but then their digital assets division, they went and raised capital, raised equity, and diluted shareholders. So, it's not as if that great quarter kind of grew book value, at least as I see it.
Going back to the cycle, so you mentioned the 4-year cycle. What is your view on the 4-year cycle? This is a big debate right now, currently. Is a 4-year cycle still relevant?
I tend to give it the benefit of the doubt. And the way I look at it is each Bitcoin cycle's gotten progressively smaller. So if we look from the trough to the peak, the last cycle was roughly a 20x return off the lows. So given that the volatility of Bitcoin has fallen roughly in half, my original view was that this cycle, maybe we could get a 10x being half of 20x. So that would have been that 160 to 180K level, depending on if you're looking at like the daily close or the weekly close. Obviously we haven't hit that, and that's looking like a pretty tough bogey for this year. So now let's flip it and look at the peak to trough decline. So last cycle, 2022 cycle, Bitcoin fell 78% from the peak to the trough. It was the same decline as Meta stock. Again, volatility is down by about half. So half of a 78% decline would be roughly a 39% decline. That brings us to the high 70s. So I think, and if you look at the chart, there's considerable, I think, support in those high 70s. So I look at kind of downside as being high 70s, upside is retesting old highs. That leaves me, modestly bullish on Bitcoin here. But I think that year-end target is out the window at this point, and respecting the 4-year cycle in the portfolio that I manage, we did take down our risk about 2 weeks ago in some of the highest beta stocks that we own, giving a bit more respect to the 4-year cycle.
The global financial system is rapidly moving on-chain, and today's sponsor, Cool Wallet, is a name worth watching. Cool Wallet builds next-generation cold wallets designed for a world where real-world assets, payments, and savings live on the blockchain. Their flagship credit card-sized hardware wallets combine CCEAL6 Plus secure element protection, mobile-first usability, and a unique 2+1 factor authentication system that requires your phone, your biometric ID, and your card to approve every single transaction. So here's a Cool Wallet Go card. It's an easy-to-use, on-the-go, card-sized hard drive that stores your private keys and literally fits inside your wallet or purse. Activating the card is simple. It takes about 30 seconds. All you have to do is download the Cool Wallet app and follow the on-screen prompts. Let me show you now. Activating a new wallet is very simple. Simply go on the app, click on Add Wallet, and it's going to ask me if I have a card. Yes, I have a card. Every time you order a Cool Wallet Go product and package, it comes with 2 cards, primary and backup. It's going to ask me which card type, in this case, Cool Wallet Go. Notice how it pairs with NFC. Click on that, create a new wallet, activate primary card. Either of these cards can be your primary card. Simply scan the card by tapping it to the back of your phone. Success. And it's important to know that you need the primary and backup cards to be able to fully activate the entire wallet. So both of them have to be active. Now create a new pairing password. This is important for when you need to recover your wallet in case your cards are ever lost. Generate by card. It's going to ask me to generate a private key. Tap my primary card, start setup. Now it's pairing my private key to the primary card. Now that both cards are paired with the private keys and activated, the wallet is ready to go. As you can see, it's a brand new wallet, so it has no funds in there. Every time you put money in there and you want to transfer funds to another wallet like this, for example, it will require you to scan and tap the card to the back of your phone as a security precaution. That's just one of the benefits of using Cool Wallet. It's very secure. Remember how I said to remember your pairing password? Well, if ever you lose the card, go to settings, go down, replace primary card, and it's going to ask you to enter your pairing password. That will start the process. So once you've activated the wallet, you can use the app to swap to other tokens and cryptos. All you have to do is first click on the manage icon on the app, add the crypto that you want, then go to the home page and click on swap, and the crypto you just added should be there. You can also send cryptos to another wallet, making peer-to-peer transactions instantaneous and frictionless. There's also an earn function that allows you to stake your holdings to generate yield. Cool Wallet also recently launched a breakthrough fiat on-ramp feature. So instead of going to a centralized exchange first, you can on-ramp directly to Cool Wallet. Users can create a bank account under their name and a fiat currency of their choosing that's available, wire the funds in, and have those dollars automatically converted into a stablecoin that's on-chain, directly into your wallet within minutes. With support for 40-plus mainnets, staking, lending, NFTs, and advanced clear signing protections against phishing and malicious contracts, Cool Wallet is positioning self-custody for mass adoption. To learn more, go to the link down below or scan the QR code here. And if you do use my code, you'll get a 5% off on your first purchase. I'd also encourage you to check out my interview with Cool Wallet CEO Michael O for more details on the product and why we need self-custody today. And he also explains in great detail how the security functions work. Link also down below. So anything that changed in ETF flows or capital flows in the last 2 quarters that may have adjusted your target for year end or into Q1 2026, besides just the cycles discussion that we just had?
Well, tactically, there's definitely some controversy in the markets about whether the Fed's going to cut rates in December, and I think the more hawkish tone struck by some of those FOMC members is keeping a lid on risk assets overall. And if you look at Bitcoin correlation with Nasdaq, it's back at local tops. It's above 0.6. So we're back in those kind of that 2022 range when BlackRock delayed the launch of the Bitcoin ETFs because they said, hey, the correlations with Nasdaq is too high. This is not what clients have signed up for. I think it's Bitcoin trading more with risk assets.
My question or concern with the Bitcoin 4-year cycle has always been, if it was that easy to follow the cycle repeatedly, why isn't everybody doing it? And I had this question 4 years ago as well. How would you, if somebody would ask you, Matthew, is it really just that easy? You look at a 4-year cycle and then, see how much it's climbed or declined post halving, and then extrapolate. Why bother doing additional analysis? How would you respond to that?
Yeah, nobody knows the future exactly. Best thing that we can do is look at the past, identify similarities and differences, and make a educated, risk managed bet. So, I don't have a great answer for you, but sometimes consensus is correct.
Your earlier model from when I talked to you in April counted on a 30% retracement for Bitcoin from its top. I think that's basically what we're seeing now. A little bit, maybe a little bit more than that from its top. So maybe this is the correction before the final Q4 rally into 2026. I mean, is there any? Have you given this some thought?
Yeah, I mean that's absolutely a possibility. I think that those highs become considerable resistance given the 4-year calendar. And, that's why many market participants are okay with taking down risk and selling rallies.
I think long term, if you look ahead, and let me just pull up a long-term Bitcoin price pattern. Speaking of historical price performance, in the past, it seems to have been the case that Bitcoin has found a floor somewhere just off its highs. So let's take the last 5 years, for example. Bitcoin peaked around $69,000 in 2021. It retraced down to about $17,000, $16,000, found a floor about, more than 70% from its highs, and then retraced back to above its highs, and then we had $100,000. Maybe we can extrapolate that and say, well, given previous cycles performance, we can make the floor somewhere. And by the way, the past floor was the highs from the previous cycle. So 17,000 was the low in 2022, which was also the high in the previous bull cycle. So maybe the floor here is 69, which is the previous high in 2021. I mean, does that make sense to you? I mean, you already mentioned that $70,000. I'm just looking at another slightly different way here.
Yeah, I think that would be a bigger decline than what the Bitcoin volatility implies, but totally possible. But I don't want to come off as one-way bearish, because whether we're looking at funding rates, which have collapsed, the average ETF buyer since inception is now underwater on their Bitcoin ETF purchases. That is a dynamic that's only hit twice since the launch of the ETFs, and it marked a bottom both times. And then short-term holders also sitting on more losses than they have since November 2022. So there are a number of, I'd call them mini capitulation signs in the market. We haven't seen the long-term holders dip into losses yet, which is usually something which marks a cycle bottom. So I see the risks as pretty balanced here, but given the 4-year cycle, I've taken down risk relative to where I was 3 months ago.
Okay, so you mentioned that the whales are not selling, or at least you haven't seen evidence that they are en masse. What would incentivize them? What market conditions would, in theory, incentivize the major treasury companies or the whales alike to start offloading?
I think you alluded to it with the digital asset treasury company mention.
Yeah.
So there's a couple of DATs that have already begun to sell their coins, more in the Ethereum ecosystem than in Bitcoin. But when I look at publicly traded holding companies across the world, many of them trade at huge discounts to their net asset value, especially when there's no clear path to returning cash to shareholders or unwinding the vehicle. So we're starting to see some activism pop up in these names. I noticed that a hedge fund just took a large stake in Pomp's Bitcoin treasury company, complaining about the executive compensation there. So now they haven't raised debt yet, so that puts them in reasonably good shape. But I think that would be the unwind of some of these DATs would show up as whale selling, and that would be I think a pretty obvious bottom.
This recent piece of news I want to bring to your attention here. So we have an Ohio Republican Senator Representative Warren Davidson introduced the Bitcoin for America Act on Thursday. He said it would not only allow taxes to be paid in Bitcoin, but it will also direct those payments into the U.S.'s strategic Bitcoin reserve. If passed, that would be huge. I remember the anti-Bitcoin people arguing a few years ago with me that Bitcoin isn't money because you can't pay taxes with Bitcoin. I think they were making a metaphor, but for money. But well, here you are. You can literally, if this were to go through, you could literally pay your tax. Would this fundamentally change anything, though?
It would provide a mechanism to build the U.S. strategic Bitcoin reserve. So I think it'd be tremendously positive. I just think the odds of passage are minuscule. So the states are moving a little bit more on this front. New Hampshire was the first state to pass a strategic Bitcoin act. And then this week, they released a mechanism for Bitcoin-backed bonds. That is quite interesting. It allows for essentially a framework for issuing Bitcoin-backed municipal bonds. It's over-collateralized debt for now, so not tremendously capital efficient. But if that's a structure that gains some traction, it could serve as a framework for a national bit bond. But I'm not too optimistic here that Davidson's act is going to get much traction in DC.
Okay, before we move on to Node, the ETF here that you're managing, let's talk about, just finish off a macro. So this is basically the theme of our conversation. Crypto market sell-off, $1.2 trillion over the last couple of weeks, wiping the cryptocurrency market. Concerns about lofty tech valuations and the path of U.S. interest rates are issues cited in this particular article. Are there other macro variables that would impact capital flows in and out of crypto at this particular point, or is it really just a tech derivative play? And we're looking at basically how tech is performing and the direction of Fed monetary policy as main drivers.
Yeah, I'm going to go back to my comment that Bitcoin miners are actually the tip of the spear on the AI trade. And so when the debt markets are weak and that causes risk appetite to retrench and hits Bitcoin, it makes those companies even more levered because they have these huge capex needs that they need to spend to build their AI infrastructure, and they're funding it through Bitcoin. And it basically caused a bunch of Bitcoin selling in October as those companies raised capital. So, but most of those stocks are down 30 to 50%. S&P's down, less than 5% peak to trough. So that, that's how I see it.
Can you expect the same leverage to the upside? Let's say we have a huge rebound in the stock market. Could we see Bitcoin push even above? Because you mentioned potentially retracing its highs, maybe above its highs. What would be the catalyst if that were the case?
I think we'd need a fundamental catalyst in order to take out the 126 highs. My personal view over the years is that sovereign adoption will be the path towards that. Did notice in the last couple months that Japan has recently become more aggressive in Bitcoin mining. So one of their largest utilities placed a big order for Bitcoin ASICs in order to help stabilize their electrical grid. So, some type of Bitcoin strategic reserve coming from a G20 country, that might be something that could catalyze new highs. Last week, the Czech Republic announced that they purchased Bitcoin in their central bank for the first time, but it was a very small purchase of $1 million. So something, order of magnitudes larger than that might also help. But even this morning, when equities were really strong on the back of the Nvidia results, obviously that is all faded intraday. But Bitcoin was a laggard even at the open. So there does seem to be a bit of a tone change in the markets here, where market participants are selling rallies, specifically in crypto.
Okay, let's turn now to another sector in the crypto ecosystem here. The VanEck Onchain Economy ETF has outperformed Bitcoin year to date. If you just take a look at its performance so far, Node, NODE, I believe is the ticker. Tell us about the general thesis here. What is the on-chain economy? And then we can talk about some of its constituents.
Yeah. So the feedback that we've gotten from speaking, especially to like more institutional advisors in the space who want exposure to crypto via equities, because that's the universe that they understand best and which fits into their typical reporting and broker relationships. Most of the equity geared crypto products are characterized by a lot of leverage. So many of the, I'd say, competing funds isolate their holdings to pure plays in the space, companies like MicroStrategy and Coinbase. And those companies tend to be pretty levered. They often have debt. And the way these indexes are constructed, you end up overweighting the levered companies at the top of the market. And it's led to a very volatile experience for shareholders. So we absorbed that feedback. And with Node, we are trying to build a more diversified, all-weather portfolio where the investment universe is not limited just to pure plays, but to any company that has identified Bitcoin, blockchain, digital assets, either as a driver of additional revenues or also as a driver of cost savings. So instead of having, 15 or 20 names in our investment universe, which is really the number of like legitimately sized equities that are pure plays in the space, our investment universe is 150 stocks, and they span every single sector. And so we've built a portfolio with more diversification, smaller position sizes, touches every sector of the market. And I think we're doing a good job of smoothing out what is a very volatile space. So we've been able
clearly, yeah. I mean, the fund has
materially outperform Bitcoin, and yet without additional volatility. And I think that speaks to the diversification in the space, along with our research, which identified this intersection between the Bitcoin miners and the AI theme very early.
So I'm going to just take a few snippets from the fact sheet here, and I think this is important. So it basically, you're optimizing for the Bitcoin cycle is the theme of this particular ETF. Node dynamically adjusts its exposure in alignment with Bitcoin's market cycles. In bull markets, it prioritizes growth by overweighting crypto ETPs, miners, exchanges, asset managers, and hodlers. In bear markets, it shifts to capital preservation, favoring TradFi enablers, semiconductors, hardware, consumer, and gaming sectors. That's interesting. What are you more favoring in now? That could basically reveal your stance on where we are in the cycle, which we already discussed, but the positioning would give you an indicator as well.
Yeah, I mean, I want to manage expectations around the capital preservation part, because we have had a probably like a 20% drawdown here over the last month or so, but relative to the benchmark that we're measuring ourselves against, which again is isolated to pure plays, we've saved a lot of performance. So a couple weeks ago, it was right around the time when some of these Bitcoin miners were announcing big deals with hyperscalers, and the stocks were doing really well. And when we looked under the hood at the economic returns that they would earn from these deals, we thought maybe the stock market was getting a bit of ahead of itself. So we sold about 15% of our kind of highest flying names and redeployed them into lower volatility stocks that we think still will provide some exposure to Bitcoin. And I would describe ourselves as, more cautious than we were 2 weeks ago. But yeah, as you see the holdings there, close to 12% in the Bitcoin ETF and almost a third of the portfolio in the Bitcoin miners, there is still considerable exposure. So lower than it was, lower than the pure play funds, but still exposed.
I'm curious how TradFi financial institutions fit into the on-chain economic ecosystem here, given that they've traditionally been laggards in adopting crypto technologies. And in fact, financials are the second largest sector in your sector weightings.
Yeah, I think the Bitcoin miners are technically classified as financials in the GIC sector, so that's why that shows up.
Okay.
In terms of the kind of traditional market participants who are getting more aggressive in Bitcoin and blockchain and digital assets, I think like a lot of disruptive technologies, the biggest beneficiaries are actually consumers via lower prices and choice. But when we look at companies like Robinhood, like Interactive Brokers, who are stressing the benefits of tokenization as a way to delight their customer base, right? Their customers want to be able to move their assets on and off the platform without faxing a form to Vanguard, which is what it takes. And then no one calls you back, and 3 weeks later, your assets suddenly move. Like, it's a pretty frustrating experience. And some of the brokers that are on the front foot in this trend are going to make it easier for you to move your assets on and off the platform. That could be a negative in the short term, right? But over the long term, it probably delights the customer and helps them grow market share. So, those are the two of the names. But there's fintechs like Shopify, Mercado Libre, C Limited that are adopting stablecoins as a way of empowering their merchants to disintermediate the banks and the credit card issuers. And then there's loan originators like Figure, who's originated more than $15 billion worth of home equity lines of credit, and then is using the open source blockchain Provenance that they helped develop as the source of truth, and has really built an entire ecosystem around that blockchain, delivering cost savings through the origination process and allowing them to gain profitable market share. So I think, our idea here is that there's more than 150 stocks that really have plans to make money or save money from the on-chain economy. And we're trying to own a large number of them, basically the best half, extremely diversified, and then let that rising tide lift the portfolio, hopefully with a lower level of volatility than what you get from the pure play equity funds.
It says here you're meaningfully tied to the on-chain economy. You mentioned stablecoins. I think some of the themes that have been brought to my attention that are developing in the on-chain economy. So the adoption of stablecoins and also the tokenization of real-world assets are two emerging themes. So you mentioned Shopify, adopting stablecoins. How are companies adjusting to the tokenization of RWAs and the tokenization of securities as well that's happening?
I think we're still pretty early in this trend, and at the moment, it's largely a B2B phenomenon with a little bit of B2B2C. So companies that move a lot of money around the world, either internally or to satisfy their business customers, think about crypto exchanges, market makers. These are the folks who are trying to squeeze just a few extra bips of margin out of those money movements. On the consumer side, it's going to take a pretty large change in consumer behavior to get folks to adopt, say, an Amazon stablecoin versus using their Chase Rewards card at Amazon. So when when you look at my holdings in Node, I'd say more of our focus is on the immediate opportunity of how demand for AI is transforming Bitcoin miners, and our positions in the stablecoin winners, which I'd say Ethereum and Solana even fit in that as the open source rails that will transmit much of this value. You'll see generally smaller position sizes. And then as the thesis hopefully is validated and the AI trade plays out, maybe in a year or two, some of those position sizes will be different.
Before that happens in a year or two, anything happening in the coming quarter that you're looking out for on the economic calendar that may or may not meaningfully change your tactical positioning?
Well, there's always something, but I'll pick a stock as an example. A company like Circle that came to market via IPO 6 months ago at $30 a share. We participated in that IPO and correctly identified that there's a shortage of pure play stocks in the space, and history has shown that the market will pay pretty high multiples for that scarcity value. We clearly thought the company was overvalued above 200. Sold most of our position in a tax advantaged way and kind of waited for the stock to come back in. Last week, or actually it was this week, was the expiration of the IPO lockup, which means that employees and early shareholders are able to sell that stock unrestricted. So the stock's come down from a peak of 300 in June. It's now at $67, and it's pretty universally disliked. That's the type of setup that could be pretty interesting as the locked up shares now become freely tradable, and it's a good time maybe to accumulate from some of those eager sellers.
All right. Well, let's eagerly wait for your next report and analysis. So thank you very much for coming on the show, Matthew. Where can we follow you and your work at VanEck?
Sure. Yeah. Please follow us on X, Matthew_Sigel or VanEck_US, and we'll put out our research there.
Okay. Thanks very much, Matthew. Appreciate your insights and updates as usual. We'll follow Matthew. I'll put the links down below, so make sure to click on those links. Thank you again, Matthew. We'll speak next time.
Thanks, David.
Take care, and thank you for watching. Don't forget to like, subscribe.